Intermediate accounting 18B, weighted average shares, dilutive and non-dilutive securities. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our website, stltest.net. I want to start off with a definition of earnings per share as an introduction into the calculation we need to do for weighted average number of shares. So earnings per share, EPS, very generally is defined as net income less preferred dividends divided by weighted average shares outstanding. So you can see that we have earnings or income on the numerator, the top of the fraction, and we have weighted average shares on the bottom. A good thing to keep in mind for earnings per share is that we are only including earnings per share of common stock in the calculation. So any amounts that we are committed to pay as a dividend to preferred shareholders are removed. Diluted earnings per share is a calculation that assumes that anything that can be converted into common stock is converted. And there are 4 or 5 types of securities that can be converted into common stock, and especially if you're taking the CPA exam, these are the ones that are covered. Convertible preferred stock and convertible bonds, stock options, rights, and warrants. And you'll see that I have some references here to some great Investopedia pages, there they are, that explain more about the if converted method and the treasury stock method that will come up later in this discussion. Some great sites here from Investopedia. So what I want to do first is go down and talk about a calculation of weighted average shares, assuming that, none of the converted items are assumed to be converted. So this is non-dilutive earnings per share. Let's assume that nothing that can be converted is converted. So our scenario is on January 1st, we have 10,000 common stock shares outstanding. On April 1st, we issue 2,000 more. And on June 1st, we issue 2,000 more. So the way to set this up to figure out average shares is to divide it into periods of time. So for example, for the period from January 1st to April 1st, that 3-month period, 3/12 of a year, we have 10,000 shares outstanding. Then we issue 2,000 more shares, which means we have a total of 12,000. And that's the outstanding amount between April 1st and June 1st, which is 2 months or 2/12. On June 1st, the firm issues 6,000 more shares. That gets us to a total of 18,000 shares, and that's from June 1st to about mid-November, which is about 5.5 months out of the 12. And then on November 16th, we have another event happening, and I'll get to that just a little bit later. So, January 1st, we have 10,000 shares of common stock outstanding. We also have 2,000 shares of convertible preferred stock that can be convertible into 8,000 shares of common stock. And I'm going to add in here that we also have 2,000 shares of stock options outstanding that can be converted into common stock. So, in addition to the 10,000 shares already outstanding, we've got another 8,000 that could be converted from preferred stock. We've got another 2,000 that could be converted from stock options, but for basic earnings per share, assuming no dilution, we just count the 10,000. Now, another thing that happens is that on November 15th, 16th, we have a 2-for-1 stock split, and you'll note that I list that stock split in 2 ways, either 2:1 or the quote 2-for-1. Either term refers to a stock split. So what that means is that we have 18,000 shares outstanding before that November 16th date. And so on November 16th, we multiply the 18,000 shares by 2. For every 1 share you did own, you now have 2. What that requires you to do in the calculation of weighted average shares is to go back to every date before November 16th and multiply the shares by 2 so that you have an apples to apples comparison when you calculate weighted average shares. In other words, if you didn't multiply the January 1st 10,000 shares by 2, you wouldn't have an apples to apples comparison, because in fact these 10,000 shares, these 2,000, and these 6,000 all need to be multiplied by 2 for the stock split. And then finally, for just the basic earnings per share, we multiply across by taking number of shares times the fraction of the year, 3/12. We have to multiply by 2 for the stock split. We get 5,000. Same thing here, 12,000 in blue times 2/12 of a year times 2 for the stock split, 4,000. And you work your way down. Now you'll note that the 36,000 from November 16th to the end of the year is a month and a half. We do not have to multiply that by the split because we already took the split into account for those shares. So if you sum them all up, you're going to get weighted average shares outstanding for the year of 30,000. And what we do with that is that becomes our denominator when we calculate earnings per share. So the last thing I'll do on this video is talk about that. If our net income less preferred dividends is $91,000 and we divide it by the 30,000 shares that I figured out down here below, see if I click on it here, you'll see that it's linked. So if dollars net income less preferred dividends is Z, weighted average shares is Y, Z divided by Y is our basic earnings per share calculation of $3.03. And so what we've done is we have calculated weighted average shares outstanding using basic earnings per share, assuming that none of these items that could be converted get converted. And then we use net income less preferred dividends numerator, weighted average shares denominator, and we get basic earnings per share of $3.03. On the next video, part 2 of this, I will go on and explain how we can calculate diluted earnings per share. Remember that on the website, stltest.net, you can find our books, All-in-One Accounting All-in-One for Dummies, Cost Accounting for Dummies, and importantly this fall, the CPA Exam for Dummies book comes out in September of 2014. And keep in mind that you can find all of our videos listed on the site down here at the bottom. And if you need tutoring services, we offer tutoring too. Thanks very much for watching. We'll see you next time.